Welcome to the deep dive. For this analysis, our surveillance period was November 19th through the 27th, 2025, and we were really focused on a couple of things.
Mhm.
First, the big shifts in the national capital investment climate, and second, how those macro trends are, actually playing out on the ground, specifically in the Dallas-Fort Worth retail market.
And if we had to just boil it all down for you, the high-level takeaway is pretty clear. Commercial real estate, CRE, it is definitely past its effective trough.
So the bottom is behind
The
us.
bottom is behind us. Capital is coming back, and it's coming back fast. But, and this is big but, this isn't a rising tide that's going to lift all boats. The recovery is demanding highly, and I mean highly, selective investment.
Okay, so let's start there. Let's unpack this national capital inflection point first. The sentiment shift is it feels pretty real. The institutional consensus we saw in our sources is almost unanimous that the markets really bottomed out at the end of 2024.
And that consensus is now backed by hard numbers. This is where it gets really interesting. CRE prices. They're now rising at the fastest pace we've seen in 3 years. We're talking a 4.2% annual gain.
A solid number.
It's a very solid number. And crucially, that valuation disconnect we've been talking about for so long, that gap between a seller's asking price and what a buyer was actually willing to pay, has reportedly just evaporated.
And that evaporation is everything, right? It's what allows deals to finally close. It unlocks the whole pipeline.
Exactly. And we're seeing debt liquidity as the main catalyst here. That easier access to financing is driving a 28% surge in overall CRE transaction activity.
28%. And it seems like it's being powered by mid-sized deals, which suggests, it's the regional players and private equity leading the charge back in.
It's not just the volume either. It's the character of the lending itself. The environment is now being described as highly competitive. That means banks, who can see the trough is in the rearview mirror, are getting aggressive again about CRE debt.
I saw that permanent financing volume was up 36% in Q3 alone.
A massive number. And what that tells you is that smart investors aren't just taking out bridge loans. They are actively locking in today's rates. They're trying to reduce future volatility risk.
Okay, but let me push back a little on highly competitive. Isn't that kind of aggressive lending what got some sectors into trouble in the first place? What's different this time around?
That's a fair question.
Yeah.
I'd say the difference is the selectivity and the cost of capital. Banks are competitive, yes, but they are really prioritizing asset quality and sponsor strength. And because of that rising confidence, we're seeing risk premiums shrink.
Which we can track by looking at cap rates.
Exactly. For anyone listening, when we talk about cap rates declining, it's a direct reflection of investor confidence. A lower required return means equity buyers believe the underlying risk of the asset has gone down, and we expect to see more of that into 2026.
Okay, so the capital markets feel healthier. But what are the red flags? What should we be monitoring?
Well, despite all this confidence, the cost of capital and elevated interest rates are still the top macroeconomic risks for the next 12 to 18 months. No doubt about it. But the really surprising thing we found was on the operational side.
Go on.
There's this disconnect. Surveys show that general worry about cyber risk is declining. But real-world events last week completely contradicted that. We saw huge banks, JP Morgan, Citi, get hit by a cyber attack on a key mortgage software vendor.
So it wasn't an attack on a single bank, it was an attack on the infrastructure.
Precisely. It moved cybersecurity from an IT problem to a top-tier systemic risk for any firm in the CRE space. It just shows how interconnected everything is through these third-party vendors. And, that kind of macro risk actually reinforces the appeal of defensive assets, which brings us to retail.
Right. Shifting to retail, this sector has been surprisingly strong. Analysts are calling it a new equilibrium. Net absorption is positive, which means more tenants are expanding than contracting.
The fundamentals there are just exceptionally robust. We saw retail investment volume hit $49.5 billion through the third quarter. That's an 8% increase year over year. But the expansion isn't random.
It's surgical.
It's very surgical. It's focused on core locations and necessity retail. Think grocery-anchored centers.
And why the selectivity?
Because the consumer outlook is still a bit murky. Analysts are citing very real headwinds heading into 2026, so retailers are hedging. They're only committing to the safest, most demand-driven locations.
That selectivity really highlights the need for operational excellence. We saw that Simon's takeover of an upscale mall operator led to 105 layoffs. So even in luxury, they're focused on efficiency.
And then you have the flip side, a huge cautionary tale. the implosion of the PropTech unicorn Sonder. Their model is all about high-risk strategies, master leases, and a growth-at-all-costs mentality.
Okay, for our listeners, what's the core risk with that master lease model?
Essentially, you sign a very long, very expensive lease on a whole building, and then you have to cover that massive fixed cost with short-term rentals. If occupancy dips, or if your management is sloppy, those liabilities become crushing. The market is now severely punishing those models.
It's a return to more conservative, traditional structures.
Exactly. But property owners are getting creative too. We saw some interesting things about using vacant retail spaces as, quote, a blank canvas for artists.
A savvy move. It turns a negative into a positive. It generates some buzz while you wait for the right long-term tenant.
That kind of adaptation is what modern retail is all about.
So let's bring this home to DFW retail. Because the market here shows this fascinating split that you really need to understand if you're putting capital to work in Texas. We know DFW retail rents are strong. We're hearing numbers over $25 a square foot.
Right. Strong fundamentals, strong rent growth. That should mean a ton of investment activity. But, and this was a major finding, Dallas retail investment activity was reportedly cut in half.
That's a huge contradiction. If consumer demand is pushing rents that high, why isn't capital following?
It's extreme selectivity. It illustrates that capital is very cautious about deploying outside of that established core necessity retail. Investors will pay a premium for a stable grocery-anchored center, but they are holding back on almost everything else until that consumer picture gets clearer.
So you have to be laser focused.
Yeah.
And we saw a perfect example of what is getting funded. Whitestone REIT acquired the World Cup Plaza Shopping Center in Dallas, 90,000 square feet.
A prime example, core, convenience-oriented. That's the priority. And looking forward, DFW is baking retail into its major mixed-use plans. Just look at the groundbreaking for the Valley View Mall redevelopment.
Now branded as Premier at Dallas Midtown.
That's it. And Phase 1 is a 6-story building, 296 luxury apartments, but with 13,500 square feet of ground floor retail. They're calling it the activator piece for the whole Dallas International District. It shows retail is absolutely integral to their future plans.
And all this development is supported by massive infrastructure projects. The Dark Silver Line, a $2.1 billion rail project, is underway. It's going to connect DFW Airport to 7 different municipalities.
That's the logistical backbone. It lifts everything, industrial, office, and, yes, retail. And speaking of industrial, Holt Lunsford is building a massive 1 million square foot park in Fort Worth to meet that constant demand for distribution space.
Which all confirms the long-term demographic health that supports the retail consumer base. Okay, but let's briefly touch on the other big sectors in DFW. What's the story with office? I keep hearing this term, Y'all Street.
Y'all Street, right. Well, DFW office is really a tale of two cities. It's still the state's weakest link for older Class B and C properties. Those are really struggling.
But Class A is a different story.
A completely different story. Private capital is actively targeting momentum in the Class A office sector, and it's all being fueled by that growth in financial services, hence Y'all Street and the plans for the new Texas Stock Exchange.
And we saw TPG acquire 4 Class A office towers in the Harwood district. That's nearly 900,000 square feet. That's not a small bet.
That is a massive institutional vote of confidence.
Yeah.
But what's really fascinating is the value at play. We're seeing private equity firms buying decade-old buildings for as low as $60 to $80 a square foot.
$60 to $80 a foot, that sounds like a fire sale.
It is a deep undervaluation.
Mm-hmm.
But they're betting that after repositioning those assets, they'll trade for $240 to $300 a square foot within 24 months. It signals they see a huge temporary mispricing in certain submarkets.
And really quickly on multifamily, we know Texas has been dealing with oversupply. DFW vacancy is, what, 11.8%?
It's high, no doubt. But the forward-looking news is good. New supply is projected to decline significantly in 2026 as construction pipelines finally slow down. So the current situation is viewed more as a temporary glut that needs to be absorbed, not a fundamental flaw in demand.
And finally, there was a big regulatory development. The software company RealPage, which is based in Texas, settled antitrust claims over its AI rent-setting software.
This is a landmark shift that affects every landlord using this kind of tech. RealPage has to stop using competitors' non-public data. And crucially, they have to remove auto-accept features for rents unless they're manually approved.
So it injects human oversight back into the process.
Exactly. It completely changes how AI can influence rent setting. For landlords in DFW, it means immediate software adjustments and probably a little more administrative overhead.
Okay, that is a huge shift. So, to summarize our deep dive for you, the capital markets are back. The trough of late 2024 is confirmed.
Absolutely. But that capital is surgical. For DFW retail, you need a laser focus on necessity retail and high-quality mixed-use spots. The long-term confidence in DFW's office and infrastructure, like those Harwood District deals, reinforces the overall health of the Metroplex.
The key then is distinguishing between the health of the DFW consumer and the short-term hesitation of capital to invest in anything but the absolute best retail asset.
Right. And if you connect this to the bigger picture, we saw $10 billion allocated nationally to AI infrastructure this month alone. You have DFW's massive growth, you have the infrastructure, you have all these financial and tech jobs moving to Yall Street.
So the final provocative thought for you is this. What specific piece of specialized retail real estate, whether it's a convenience center or ground floor mixed use, do you think is best positioned to capture the immediate spending power of that new affluent wave of professionals arriving in 2026? Think about that precise location and that asset class as you plan your next move.